Hello everyone, it's Edwin Agrone here. Today's video is going to be about real life numbers of rental property ownership. We're going to dive into the cost of the rental property, what you should be paying for it, versus what the rents you should be charging and how to configure that, and how you can make any property cash flow. Before we dig too deep, please like and subscribe to my channel. I'm going to continue making videos on business, real estate, and personal finance. Well, let's get back to it. A rental is a great way to earn extra money. Well, it depends on the deal. It all depends on the deal, what your purchase price was, how much the rents are, and where the rents could possibly go to. That is where every deal starts, is at the purchase price. You're also going to want to read up on tenants' rights and your rights. Knowing what the legalities are, what you're responsible for and what they are responsible for is very important, and it's something you can do before you buy the rental property. In your search for a rental property, you're going to want to look at some things. The location, you may want to look at the school systems. You also may want to look at the job markets. Are there jobs around? The crime rate, things like that. Things that will make the place desirable to live. A low crime rate is going to be a desirable place to live. As well as like the marketplace rents like we've spoken about in the past. Those things are going to dictate your success, and as well as how much you should pay for the property. So all those things you need to take in consideration before you purchase it. So how do you find a good deal? You have to find a property where the rents are 1% of the purchase price, as close to 1% as you can get it. So if the rents are $2,500 a month for the entire building, if you're buying a duplex, that means your purchase price needs to be as close to $250,000 as you can get it. Be sure that your investment property cash flows. You can do this, you can figure all of this out before you buy it. You'll sleep a lot better at night knowing that there is cash available and that you've got a stash of cash in savings just for anything that could go wrong there. If you purchase higher than the 1% rule, you are going to risk the property not cash flowing. A non-cash flowing property is one of the worst mistakes you could ever make in your life. You could end up in bankruptcy by making a crucial mistake by overpaying for a property. The deal is always in the purchase price when it comes to rentals. There is a way that you could purchase a property that is higher than the 1% rule, but it just requires you bringing more money to closing, meaning you're putting more money down on the property to lower that monthly payment so that the property cash flows. The most obvious way to make a property cash flow is to raise the rents. But when you raise the rents, you do risk losing tenants. So if you're planning on buying a property and your goal is to raise the rents immediately to make that property cash flow, just remember that you could lose tenants, and if those tenants move, you will be out months of rent, or a month at least, depending on your knowledge of getting new tenants, your ability to get new tenants. It could hurt you long term rather than leaving that tenant in there for another 3 or 6 months. Before you try and instill that game plan though, you really need to do your market research. You need to get a hold of a realtor, see what the comparable rents are in the area, and make sure that you're not overcharging for rent. If your property can only cash flow by being too high on rent, then you have to walk away from the deal. The purchase price is just too high. If your game plan is to raise the rent on the tenants, then you have to check their leases. If their leases are not expired, then you're not going to be able to raise the rent until the end of the lease. If you end up going above that 1% rule and you end up putting more money down to bring the mortgage payment down, just remember your cash on cash return is going to be much lower. So you have to weigh those things when you're making decisions like this. You decide to go above the 1% rule, your cash on cash return is going to change because you're going to have to put more money down. With that being said, cash on cash return is defined as the rate of return of the money that you have invested. When dealing with investment properties, this is simply put as the percentage return on the amount of cash you paid to purchase the property. This is calculated before taxes. So think about it this way. If your mortgage payment's $2,500 and the rents are $2,200, $300 cash flow is not enough. If you get involved with a deal like that, you basically just took a bunch of cash, put it on a lead ball, and threw it in the middle of the ocean. Eventually, a tenant is not going to pay you, and you're going to have to pay the difference in that mortgage payment. It could take 30, 60 days, 90 days in some counties and some states to get a tenant out. So buying them correctly at the correct purchase price, trying to use 1% rule is the only way I do it. I can hear some of you now saying, what about the equity month to month? What about the equity year to year? That property is growing in value every year. Isn't that my money too? Can't I just make the payment straight up? If it was $2,500 in rent and the mortgage payment is $2,500, why am I not making money in equity? I hate to be the bearer of bad news, but things are going to break and tenants aren't going to pay. At some point in your ownership of this property or of all your properties, you're going to run into those things. So it's just not a sustainable business model where the place breaks even every month, where your rental is breaking even, there's no cash flow. It's not a sustainable business model. It's important to remember that investments pay you. You don't pay investments. So if you haven't gathered it yet, the purchase price for me is the number one most crucial, important thing when it comes to purchasing an investment property. If that price doesn't hit that 1%, I'm out. I continue my search. I can find another property eventually. And not every market's a great market to buy rentals in. Sometimes you have to wait the market out. Now, most lenders require 25% down on a non-owner occupied investment property. So if you're buying it to rent both sides out on a duplex, you are more than likely going to have to put 25% down. The reason they require such a high amount down is because it's a financial risk for them. Investment properties can go south very quickly, and they're going to want some equity in the form of down payment put into the property so that they can sell it if it were to go into foreclosure. So I'm sure you're wondering, how much money can I actually make? Well, it's all going to vary with repairs and vacancies, but a good rule of thumb that I always had luck with was around 40%. I always kept about 40% of my money each month at the end of the year. It came to about 40% of the gross rents. Now, to be able to keep 40% or more, you're going to have to be handy. You're going to have to know how to fix a leaking toilet. You're going to have to learn how to fix things inside the house that are minor repairs that can really nickel and dime a property and take all your profits. Now, some may ask, but what about the depreciation write-offs? Well, let's start with the IRS definition of depreciation. Depreciation is the recovery cost of qualifying property up to a certain determinable dollar limit. In that taxable year, you place the qualifying property in service. In other words, the IRS allows for you to write off percentages of the value of the property, generally over 27 and a half years. So the mindset of some investors to buy an income property, have the property break even each year, then utilize a depreciation schedule for a tax write-off. Then after 5 to 7 years, they do a cash out refinance, pull the equity out that has been being paid off by the tenants. This strategy works well on paper, but unfortunately tenants do not always pay on time every time. This strategy is very high risk, and I never recommend it to my clients that are looking for income producing properties. However, the land itself cannot be depreciated, so you must subtract the land value from the building value to achieve the amount you'll be depreciating over the course of your depreciation schedule. So in the beginning, you're always going to want to self-manage these properties. Your first few properties, I wouldn't trust any property manager to do this. And the reason why is because you really want to be involved. You want to know what's going on inside your properties, as well as you want to gain some experience on fixing things, as well as just managing tenants. This is really the heart of being a landlord. So I wouldn't push those responsibilities onto a property manager until I probably had 5, 7, 8 duplexes before I did that. Well, there's no question that buying an investment property is a great way to build wealth. There is a ton of responsibility, though, that comes along with it. You're responsible for the brick and mortar house, everything that's inside of it, all the HVAC, the mechanicals, and then you're also responsible for the safety and well-being while the people are in that house, and the other tenants that you surround those tenants with. You're responsible for everybody's safety while they're there. The tenants that you choose that live next to each other side by side, they are going to affect you financially. If you have a bad tenant and a great tenant, one of them's loud, one of them's not, one may end up moving, breaking the lease to get out because of the other. So you really have to choose wisely on your tenants and make sure that they can coincide. With all the talk of risk about the safety of the occupants while they're in the house, the risk of just being a landlord, the biggest financial risk is obviously the mortgage. The easiest way to buy a rental property is cash. That's the least amount of risk now, but most of us can't buy a rental with cash. So 25% down, the most you can put down is what I always recommend. We've reached the end of this video. Hopefully you pulled some information out of this that you can use on your next deal. Please subscribe and like and share with your friends. We'll see you on the next one. Thanks.